And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. Okay, welcome to my podcast. Today, why, we're going to answer the question, why tech has been selling off since June. And why in the last few days, all of a sudden, it's starting to turn back up. Tech is back in play, but is it? Well, we're going to look at it. But remember, starting in June, tech started to sell off. It's been a big problem. So let's look at the reason why. And will it continue to sell off? Because remember, almost half of the money that trades during the day goes to tech. Out of the 1.3 trillion, nearly half goes to tech. The next big amount of money goes to banks. Those are the two biggest areas that institutional money or machine money, when the institutions aren't in, that's where the money goes. That's where you should be. And you should become an expert in those areas, understand those areas. All this other stuff they throw at you, the jibber jabbers on TV, healthcare stocks, all that. You only got about 6%, 4% of the money goes to those. That's not where you're going to make money. But let's get to what happened. Okay? So if you look on if you, for example, if you go and look on a chart, I'll put it up for you. I use XLK. That's the more reliable tech ETF. Okay? And you can see where we have this tremendous move from April, okay? From April 2026 up to June. It reflects it. The stochastic reflects. If you look on your chart, there's a bar on the bottom called stochastic. One's red, one's yellow. That stochastic's important because, remember, you have to understand, candlesticks move first. Whatever you look at on your chart, it's the candlestick that always moves first. And then the stochastic reflects what is going on. The candlestick reflects the behavior of the candlestick. Is money going in? Do we have volume? Because when money goes into your candlestick, your volume goes into your candlestick. That moves price. Remember, prices form the candlestick. So the candlestick is important because that's your first move right there. That's what you see move. So if money's going in there, that's going to move first. But that money going in reflects the behavior of those stocks reflecting that stochastic. So the stochastic's making a nice upturn. You know the candlesticks, we got plenty of money going to the candlesticks, and therefore you get a nice trend going up. And if you look at the trend, if you're looking at a chart right now, you go back again to April 10th, okay, 2026. Look at that beautiful stochastic trend rolling up, and that's reflecting the behavior of the candlestick, where prices are going up, volume's going in. That's how the market works. Now, all of a sudden, everything stopped in June of this year, and then it unraveled. And again, when you look at the candlestick, it moves first. The stochastic started to turn down. That red and yellow line that people never look at. And that stochastic, remember, reflects what's going on in that candlestick, the behavior of that candlestick, i.e. is money coming out. And in this case, money was coming out, so you knew your stock was going to go down. So when you listen to these jibber jabbers on TV tell you buy these tech stocks, All you had to look at was your stochastics and your candlestick, and you knew they were lying to you. And then you would set your position up to short. So all of a sudden from June 2nd to about, well, let's say at the end of July, okay, around the very end of July, beginning of August this month, it started to turn back to the upside. The stocks, okay, your tech stocks. But we don't have a confirmation yet because the stochastics, okay, are not turning up. They're not being aggressive. And remember, the candlestick, even though they're going up, if your stochastics aren't following it, and it's telling you, then you don't have enough buyers, and it becomes a head fake rally. So the reason that the tech started to sell off was because, remember, at that beginning of June, we had the hot inflation prints were coming out because we had all this hot oil spiking, strong economic data where we're getting all these jobs. That's not good for tech. And so yields started to rise. And that's not what you want for tech. Tech stocks, you want low yields. Now remember, yields, they're bond yields. We're not talking about Fed rates. We're talking about bond yields. So if you look at a chart, you can clearly see what occurred. And no matter what they're telling you on TV, it was nothing but BS. Okay, it was all BS. So if you understood how the market works, and if you understood starting in June 2nd, when you started to see the stochastics rolling over, that was reflecting the price behavior inside your candlestick. Money was coming out. You would have taken your profits, turned your position, started to short it. Only 5% of 65 million people did that, just 5%. Because 95% don't know what I'm talking about. They don't even know what a stochastic is. They think it's a banjo. They have no idea. They think they're banjo strings or something. You've got to learn how the market works if you're ever going to make money. And the reason 95% of United States traders, retail traders, lose money year in and year out, they have no clue how the market works. They think they get up in the morning, they listen to CNBC or Fox Business, write down the stock, and they're going to make money. Doesn't work that way. So let's get back to the point. So are we now turning? Has this stopped now? Has the selling that started in June 3rd and went all the way down to June 29th, okay, July 29th. Remember, this whole thing started to collapse June 2nd, and it went down big time until about July 28th. Now, just because when you look on your chart and you see XLK, or if you want to put the Qs in, or the NASDAQ, it's going up, but it's not going up for the right reasons. You have to know that. So if you want to know if your tech stocks are going up, what does it need? What does it need to push that up? You got to make sure that the yields are going down. So if you get a trend going up, but your yields aren't going down, that means the stock is in the wrong direction, but the yields are in the right direction. So a stock is going up, but it's not yield friendly, and it's going up because the big boys are pushing money into tech, but that's risk on. And we've had high risk on since July 29th to the last couple of days. Now, just recently, in the last few days, we started to see where things started to settle down, but not the yields. The 10-year Treasury yield, okay, is at 4.63. The 2 years at 4.13. They got to be in the threes. They got to be in the threes. If you're going to trade tech stock, you need them in the threes. If you start seeing tech stocks going up, if you start seeing the NASDAQ going up, the Qs going up, you start seeing XLK going up, if your stochastics aren't going down, heading towards 3%, the rally won't last. It's not sustainable. And when the 10 years at 4.63 instead of, let's say, at 3.7, and the 2 years at 4.13 instead of at, let's say, 3.2, the rally doesn't last. So here's what we know. The rally stopped dead. It started to collapse. And why did it start to collapse? Because really, the war. Because the 10-year yield started to roll over, started to drift lower. That was the big problem. Why? What was driving that yield to go the wrong way, not to be friendly? Because we had hot inflation prints because of this war. Oil was spiking. And we had strong economic data. When they come out and they say good jobs, that's bad news for the market. The market doesn't want good jobs, okay, because that means inflation. So yields, okay, started rising, and that becomes a problem. You want the yields to go down. Now, the big problem, too, we're seeing is what happened is that margin debt is huge. Huge. So we had margin debt of $381 billion, okay, in 2008. The market dropped 57%, wiping out almost 80 to 100% of the retail traders' equity. 2020, same thing happened because they don't know how to read the market. They don't understand what stochastics mean. They don't understand what I'm saying, that the candlesticks move first, and the stochastics, okay, are so important because the stochastics on your chart reflects the candlestick's behavior as to the volume of money coming in, which moves the price, and price forms the candlestick. And the stochastic reflects all that. And until you learn that and understand it, you'll never make money consistently in the market. So now the margin becomes a big problem because that hurts the stock market. Okay, when you have in 2008 $381 billion in margin debt, and then you had in 2020 $550 billion in margin debt. And remember, the market dropped in 2008 57%. The market dropped in 2020 when margin debt was $550 billion. Remember, in 2008, it was $381 billion. 2020, when it went up to $550 billion, the market dropped 34%. When the market dropped 57% in 2008, margin debt was less. It was at $381 billion. But in both cases, whether it was 2008, 2020, regardless it was $381 billion or $550 billion, okay, it wiped out 80 to 100% of retail traders' equity, and it's going to do it again. So you got to understand how the market works so you're not going to lose money. So you can at least pull your money out if you don't want to short. Now we're in 2026, and here we are, 1.5 trillion in margin debt. As I said to you yesterday, this time, if we have the same 34% drop as we had in 2020, when the margin debt was $550 billion, we get the same 34% now in 2026 instead of being at $550 billion. It's going to be at 1.5 trillion. The same 34% drop. The debt, margin debt's at 1.5 trillion. That's going to wipe out 80 to 100% of retail traders' equity. That's going to be crazy. That's insane. So when you have margin debt like this, you got to ask yourself the question, why does Wall Street keep offering margin debt when people get wiped out, when they lose 80 to 100% of their money? Why do they keep offering it? Because retail traders are getting wiped out. Why? Because margin debt wipes out retail traders, and that's what Wall Street loves. They want to wipe you out. Remember, they make big profits. They don't lose. Margin loans are guaranteed. When you borrow money to buy stocks on margin, it is so profitable for Wall Street. They get a 12% return with zero risk because you're giving them your stock for security. They never can lose. They just sell your stock. You always lose. And that's why they continue to allow margin debt to climb from $350 billion to $1.3 trillion. You think somebody would stop that? Because that's going to kill the economy. See, they're betting you'll lose. And see, people don't understand that. So again, you got to understand what is going on. The majority of money, we trade $1.3 trillion a day. The majority of that money goes to tech, nearly 50%. About 15% goes to the banks. You got to learn and understand what are stochastics. What do they mean? That will save you. You'll know the market's going to go down before Wall Street does if you understand stochastics. If you just understand that that's stochastic on the bottom of all these charts, all it does is reflect the behavior of the candlesticks, meaning, is money going into the stock or is money coming out? The candlesticks are what moves first. And once you understand the relation between the candlesticks and your stochastic, you always know before the market knows if it's going to go up or down. But Wall Street doesn't want you to know that, do they? No. So that's where we are. So we're starting to sense that again, don't get caught now. If you look at XLK, remember, the market started to drop in June 2nd. It stopped dropping July 29th, and then it started to rally. But it's rallying for the wrong reasons, because tech wants yields to go down. When the stock market's rallying and the yields are going up instead of down, then it's a head fake rally. And right now, the stochastics are just at the point. They're almost reversing. But it's going to take a lot of work. So as long as you watch your candlesticks and the relationship between the candlestick and your stochastics, you're going to know exactly what's going to happen with the stock market. You never have to ask the question again, what do you think the market's going to do? The answer is, again, in the stochastics, that reflects the price behavior inside the candlestick. And that's it. That's all you have to know. All right, so I hope your eyes didn't glaze over, but it's something I wanted to talk about, because just like yesterday, people have no idea that Wall Street wipes you out. They want you to have big margin debt so they can hurt the retail investor. Just like when you buy a stock, Wall Street sells your order. I talked about that yesterday. When you buy a stock, you think the broker, he's telling you, come work for, come with, you see all these ads right on TV. Come to J.P. Morgan. We're here to help you. And it shows the conference room and the family's there and the kids are there and grandpa's there. We're here to help you, to protect you. Are you kidding? They're there to screw you. Because the minute you buy a stock, you're thinking, hey, I'm going to invest some of my retirement money. I'm going to invest about $700,000 into stock. But you don't understand. You're screwed right off the bat. Because when you give them that $700,000 retirement fund to manage for you, and when he starts buying stocks, you think he's out there looking for a good fill order for you? No, he's not. He sold your order to a gangster. He sold your order to a gangster. You know nothing about it. You think your order went straight to the stock market floor and they're going to fight for you and get you a good price. What are you, nuts? You don't get the best price. Your broker's not working for you. They sell it like that on TV, but none of that's true. Your broker sells your order. to these high frequency trading firms like Citadel. And that firm pays your broker for your order, and you have not yet made any money. In fact, you're getting a terrible fill. Let's just say, for the sake of stocks, $100. You're going to pay, you think, oh, good, he's going to try to get me a fill of, let's see, $93 or $95 or $98. No, he's not. He's not working for you. The firm that he's selling your order to could be 2 Stigma, it could be Jane Street, there's about 5 of them. He's selling your order. He gets paid. You make the, now you've already lost money and you don't know it. They get paid every time you trade. They earn more when you trade more. They earn more when you trade popular tech stocks like Apple. They earn more when spreads are tight and predictable. Your broker makes money when you lose money. What a racket. So here's the bottom line. This is very important right now to understand, as everyone's going to tell you, the tech stocks are all going back up now. We're celebrating. But understand this. Tech stocks need a friendly, okay, yields. You want yields going down. So if you see on your chart, all of a sudden tech stocks are going up, and you check and your yields are going up, you're getting screwed. You're going to get screwed. So, and you just got to put that together, okay? Once you know how the candlestick and your stochastics work, you'll never be on the wrong side of a trade again. You'll finally be making money instead of losing money 85% of the time. And we can help you with that, okay? All right. All right, that's it. So, again, more good news for me here at Bill's Gang. I bring always the happy news to you, but I bring you the truth instead of the BS. Boy, we get plenty of BS from Wall Street, don't we? And our Congress. See you on the charts.